All right, I'm going to go ahead and get started. I'm going to record this one and hang it on YouTube as usual. Good to see Adolfo and Rodrigo on the call. So I trust you guys got home safely from a intensive and very interesting live trading workshop. I want to show a couple trades from that workshop we just completed that I think you'll find to be of a lot of interest, and a couple very powerful ideas. I get such a charge emotionally and energy-wise from those. I just can't tell you. Really, really good stuff. Okay, so we'll start with the weekend report, and then I'll cover the daily report with a couple, I think, important upgrades to the daily report to make it easier, even easier to find the trading ideas and frame them up based on suggestions from the guys at the workshop. Let me see here. All right, so what we have is a bullish, quiet market. It's at 62 out of 100 on weekly RSI 14, so it's still at the high end of normal. On the 10-day NDX, the 10-day look back, we're at 78 out of 100, so it's pulled back from that overbought condition based on some interesting weakness on Friday. I'm going to show you an 11-hour trade in the VIX when we get to the third part of the briefing, so stay tuned. Percent stretch relative to the 200-day moving average is at 7.60, or bullish, still very strong. Slope of the 50-day moving average is 1.27, coded dark green, still very bullish, very strong. ADX is at 34.6, very strong trend, very strong bullish trend. The ATR percentage remains at 1.03%, which is very quiet, and that's also good for the long side. So we've got a bull market. It's bull quiet, and market's neutral on a short-term basis. Blended monthly rebalancing, still holding IWM, IYR, and XLF in the 26, and IWM, IYR, and MDY in the 13 ETF. I should say, if you have not seen the presentation Jim Carroll made this weekend on the blended monthly, send me a note, because extremely powerful. I think we had 45 or 50 people on the call, and I just thought he did a terrific job on that. The next reevaluation is due on or about 1 March 2012. ETF2 notes the theoretical exposure is still at 100%. Model portfolio is at 100% exposed. And moving on. The only thing that happens in ETF2 is updating all the stop losses, because they were all positive this week. This is the blended monthly rebalancing portfolio, where the current snapshot, so it's sorted by the strength column. And you can see right now IWM, the Qs, and MDY are the top 3. Australia, Japan, and the Euro-Asia mix are at the bottom. In the 26 ETF portfolio, it's IWM, XLF, and the Qs among the top 3. Bottom 3, agriculture, Swiss franc, gold, and really short bond, all in the red. Moving on. Here's the market health check. So the vertical blue lines are 10, 20, and 30 days. 10, 20, and 30 days of look back. The horizontal purple line at 137 remains the swing high from last year. The horizontal red lines represent support levels where the market has pulled back to and found support before. The red blocks represent 5, 10, and 15% pullbacks from that swing high of 137. The central black line is the 30-day regression line minus 1 day, so we're looking at the previous 30 days, not counting Friday. The outer black lines represent the regression channel formed by the maximum excursion from the regression line during the look-back period, which happened in last day of January. So we have a very tight channel in this bull. So we have price just above the 10-period moving average, which is above the 50, which is pulling away from the 200. So that's still the classic definition of a bull. We have ADX at 34.6. You can see that the bulls are in charge. When the green positive DI, the DMI, crosses back over the ADX, that's the first sign of weakening of the trend, and you can see that the strength of trend is at an extraordinary high, and you can tell it just by the outsized gain that's been made so far in the tight regression channel. And so this little pullback from the top of the channel to the 10-period moving average was enough to cause the plus DI to cross below the ADX. So that's sort of a warning sign there. We would also see a warning in the Williams percent R with price coming back out of the overbought condition. Warning in the PPO where the jaws of the dragon have closed on the percent price oscillator here. And normally, when those jaws pinch shut, is an indication of a warning. That's a warning sign that the previous trend could be at a turning point. You can see the last move when the jaws opened. This was about the 3rd or 4th week of December when this bull started, and it started to get a little narrow up in here, but it really closed for the first time 10 days ago when price got to 133 at the end of January. There was a little pullback, then the trend resumed, and the jaws opened back up, but they closed again here on this pullback. So that's 2 pullbacks in the last 10 days, when the previous 20 days, days minus 10 to minus 30, really didn't pull back as much. So that's a sign of potentially this young bull weakening. The slope of the regression line has rolled over a little bit. It's still positive, but it has started to roll. So this pullback from Friday, or on Friday, with the large gap down, and then ending in a doji, is a warning sign to make sure that you are updating your stops, you're monitoring your position size and your open risk, and you're managing your profits from this bull with care. Still looks good for another test of 137. The first test bounced on Thursday then. What we need to see is a close above 137 for this bull to continue. If it fails here, or fails at 137 again, the next support level, a 5% pullback from the swing high, would bring it to 130, to this previous support level here. And that would still be within the bounds of normal noise inside the market. Anywhere from 0 to 5% pullback from the swing high we classify as normal noise. If 130 fails, the next target would be about 126-ish, and then a 10% pullback to 123, and then the next strong support at 120. If it fails below 125, then we're back under the 200-day moving average, and we will have entered sideways conditions by then. So on the upside, it's got to get through 137. On the downside, we're looking at 130 followed by 127 as the channel to be trading in. Moving on. Looking at the ETF2 database indexes, the summary here, all 10 of the indexes are on a buy signal above its 4-month moving average. So that leaves us at 100% invested, 0% cash in the theoretical model. We're in bull quiet. SPY is still better than EFA. SPY at 64 is better than EFA at 55. The strongest index among the U.S. is the NASDAQ at 66, followed by small caps at 65, SPY at 64, then the mid caps at 63. So the growth on, the risk on trade is still working in the U.S. The two strongest indexes out of the 10, the Qs and IWM. Two weakest, Japan and the Euro-Asia blend. Moving on. Next up, looking at the world market model. We see the U.S. in the center here with small cap value retaining its exceptional outperformance at 76 in the green. The rest of the U.S. is still all above average in the white. See Europe in yellow, Asia and Asia less Japan in the yellow. Inside the Asian countries, the winners being South Korea, Malaysia, and Hong Kong. They've been strong for the last year relative to their Asian peers. Followed by, in the yellow, Australia, Singapore, Taiwan, and the two weakest being China and India. The European countries have generally come out of the red, being led by Sweden, and then the countries simply being below average. Mexico and Brazil continuing the strength that we've been witnessing for about 2 months now in Latin America / emerging markets, Canada lagging a little bit here. U.S. real estate remains strong at 68, gold and silver lagging. But silver and gold have both made moves off their bottom and are well positioned in case we get the a weakening of the bull here. Inside the business sectors, the risk-on trades of tech, industrials, finance, and materials are still strong compared to the defensive plays in healthcare, utilities, and staples. So it's still a risk-on trade. Moving on. Next up is the top 30 ETFs from the ETF2 database. And it's still being dominated by ITB, the home construction, U.S. home construction, biotechnology, see regional banks, KRE, semiconductors and retail. The small cap value index, IJS, is still a very good play. That's the index that tracks that lower left-hand corner in the Morningstar style box for us on the world market model. So IJS is still an excellent play. You can see it's got $8 to its a boundary to its moving average, so that's almost a 10% positive advance over its 4-month moving average. So lots of room, lots of strength. Oil service, retailers, more biotech, the dividend, top 100. Now we're getting down into the all white areas here. So little change this week compared to the leaders from last week. Still quite a few bond funds on there. Among the Dow 30, I've got this one now sorted by the strength column. So we're looking at pure relative strength here, the 3-6 month blend. Home Depot. Bank of America has kind of muscled its way to the top here. It hasn't been good on the average or consistency or quality, but it really is standing out on the basis of pure relative strength. So that seems to be a winner right now in the financial sector. So if finances really turn around here and keep moving up, we expect to see Bank of America continue to lead the way. If financials fail, then there's a lot of profit to be preserved in here. And I think that's the more likely play, and so a potential short on if there's more weakness in finance. The usual suspects following now: Caterpillar, Disney, General Electric, Microsoft. At the bottom of the list, Alcoa, Hewlett Packard, Johnson & Johnson, Coke. And again, all based off of their relative strength calculation. Moving on. Next up is the ETF liquidity report. I'll let it come up on your screen. There we go. Those that are highlighted in green are exceptionally liquid intraday. Liquid and volatile intraday. And so you'll see China, the gold miners, and silver. The VIX with a lot of money being slung around, still only at 4.41%. Wait till you see Friday's chart when we get to it. So these are all extremely liquid, all well suited for intraday trading, and the ones in the green are exceptional candidates because of their liquidity. Okay, we're going to shift to the daily report now. So let me get that called up for you. Excuse me. Okay, now we got her on the full screen. All right, so I'm not going to cover the top row again. I want to just highlight some things on the gap stat that were very, very handy for us this week at the live trading. I want you to notice the gap down drop and then the gap down in reverse looking at the last 30 days. 1 in 14. What does that mean? That means 15 times in the last 30 days the market has gapped down. One time out of 15, 1 out of 15, the gap down then closed lower for the day. And when it did, it turned in an additional fail on the follow-through of minus 0.41%. 14 times out of 15, when the market gapped down, it reversed to close higher, and the average follow-through was an additional 0.51%. That's an incredible pattern, and one that's been was very handy to us this week. 15 times, 9 and 6, the market has gapped up. 9 of those 15 times, the gap up has reversed to close lower for an average follow-through of minus 0.47. 6 out of 15 times that the market has gapped up, it has gone on to gain further with an average follow-through of 0.36. So what I want you to notice is that there is a very important difference in the patterns of gap up behavior and gap down behavior. Gap downs have been tending to reverse. Gap ups have been tending to reverse as well, but not nearly as often and not nearly as large. So important difference. So the gap down has been the most excellent play. If you look back at the story of the last 200 days, what you'll notice is that it has a tendency to even out. So we are in a period of anomaly right here, that when those patterns start to emerge, you need to pay attention. When the 30-day pattern deviates from the 200-day pattern, that's an important moment in the market, and the psychology is shifting, the strategies are shifting, and the sooner we recognize those, the sooner we're able to start taking advantage of it on our intraday trades. You'll notice on the 10-day NDX, we've pulled out of the overbought condition. We have one signal in overreaction in EPP, that's Asia less Japan. Here are the daily pivots for reference purposes. Because Friday was such a narrow day, notice that there's only about 80 cents between, or 70 cents between, no, I guess it's 80 cents, but 80 cents between the pivot and S3 and the SPY. Volatility has continued to get flat here, hovering right around just a little bit above 1%. You can see the crossover in the ADX here. 10-day min pains, Home Depot, United Technologies, Microsoft, AT&T, and IBM. Those have been the winners among the Dow compared to their 10-day high. Among the ETF 100, the VIX is noticeable short bond. and XLP is the S&P staples. Excuse me. Under 10-day max pain, candidates for big moves: Alcoa, Bank of America, Hewlett-Packard, Cisco, and Merck. Among the ETFs, 10-day max pain: natural gas, metals and mining, gold miners, Russia, and China. We have more patterns today to work with. We get 5 days down in finance, 551Ws in Japan, Europe, Latin America, and U.S. real estate, a triple screen in materials, channeling signals in gold. We have triple screen in GE and Alcoa, and channeling in Merck and Johnson & Johnson. So quite a few to choose from going forward. I failed to update this auto framer 2-to-1. You'll see on the next chart a more current version of that indicator. All right, so there's a important change to the way I've arrayed the tactical summaries now, and it'll be the same for the Dow 30 and then also for the ETF 30. What I've done is I've compressed the price change percentages and the Tortoise NDX numbers in order to make room for 5 new pieces of information that it's useful to have on the single tactical page to make your decisions if you're using the Dow 30 or the ETF 30. All right, so a couple of weeks ago I added the auto framer reward to risk ratio. Now what I've done is I've added in the range stat, the frog standard deviation, and the frog quality number from the daily frog report, so you can see it all in one location. And then I've added the fail stat and the signal to noise ratio in here, so that on one sheet we have all the critical numbers that we need to be framing intraday trades. So I hope you find that to be useful. On quite a few dojis from Friday, not surprising because Friday was a doji day in SPY. Very little range. It was a big gap down. The extreme upper limit of normal gaps down, that 1% gap. First time we've seen that in a couple weeks. So there are lots of dojis, lots of indecision. 2 channeling signals, Merck and Johnson & Johnson. 2 triple screens, GE and Alcoa. The 5 max pain range compression candidates. The 2 that are in max pain purely are Merck and Johnson & Johnson. And then the max pain range compression, which takes into account, the size of Friday's range. Merck, Pfizer, ExxonMobil, Johnson & Johnson, and 3M. Looking just at the auto framer reward to risk, we have 3 candidates that are better than 2-to-1: Merck, Johnson & Johnson, and Coca-Cola. So I would be very interested in Merck. It's the #1 max pain range compression, has the best auto framer reward to risk. It's a channeling signal, and Friday was a doji. If there was ever a candidate for reversals and a strong move, if the market's strong, it's going to be Merck. Johnson & Johnson is very similar in that sense. I'm always interested in Coca-Cola, and it's got that 2.4%. Moving on. Oops. Taking a look at the ETF 30 tactical summary. Next. Enormous number of dojis. That's really the story from Friday, was that it was a big gap down and then indecision into a doji. Now the nice thing for the long side is that it failed to fail further. It could have fallen in a big way back to 130, but it didn't, so it stayed in the doji. So it's perfectly poised Monday for a roller coaster ride, where the folks who get scared by that gap down and pull back, who are preserving profits, will have put in a lot of sell orders to preserve their profits. And then there will be folks who are interested in gunning their stops so that they can buy inventory in the bull market shares and then push this market back up to 137. So I consider that to be, a downward or an upward move equally likely. I fully expect a big range day on Monday, and it's going to favor the well-prepared traders. Now, what is very useful to note on the ETF 30 tactical summary, you've got a lot of signals here. You have gold in a channeling, You have financials on a 5-day D. That's good. You have materials on a triple screen. You have a 551Ws in Japan, gold, Europe, and real estate. Max Payne candidates of agriculture, treasuries, and natural gas. And then the Max Payne range compression candidates, natural gas, treasuries, gold, agriculture, and then materials. Now, what's interesting to note here is that you got a ton of things that have set up very well on the auto framer reward to risk. The best one is looking like treasuries and natural gas. Asia less Japan is excellent. That's nice because that's on an overreaction signal, so I think you can stalk that one. If there's weakness in the market on Monday, that's an interesting short to take. And then you have all the, again, the updates from the frog report, fail stat, and signal to noise. You've got 4 ETF candidates that are above 3.0 on the frog quality number. The NASDAQ, treasuries, technology XLK, and then consumer discretionary XLY. So that should give you enough information to be able to frame some pretty good trades. So I hope you like the new layout. I am finding it very helpful already. I'm going to just flash through the frog signal to noise and fail stat and go right to the market mosaic, since the previous information is all on the tactical summaries now. The 30-day regression line, you'll notice that the R-squared is still very high. And here's the pullback from Friday. Hardly any variation in that upward line at all, and that's why R-squared is so high, extraordinarily high. The time series of the slope of the regression line here, when we zoom in the last 30 days, you can see that it has crossed its own 10-day moving average and starting to get weak. That's happening at a distance of more than 1 standard deviation to the mean, and that implies a potential for an intermediate swing back to normal. And right now, the slope of the regression line would have to get to 0 for that to happen, and that would mean a pullback to about 132 and then staying sideways for an extended period. That's what it would take to get that slope of that regression line back to 0. So that would sort of negate this emerging bull that we have here for it to get back to 132 and horizontal. But that's a realistic possibility. If it were to do that, that would be about a 3 to 4% pullback from 137 right now, and that would get us right back to the average on the percent stretch relative to the 200-day moving average. So that would be the downside normal swing that would get the market back into what I'd call statistical balance. Let me see. Mike has a question here that I just okay. Nice additions. Thanks. I hope you. I think you'll find it to be very handy, a way to keep this focused. And that's approximately what the radar screens on the TradeStation bundles do too. So I like having it all, being able to have it all pulled into one now. I should have done this a while ago. So moving on. I just want to take a quick look now at the percent, the hold stat, if you will. Robert called this the hold stat, holding X days. We've had about a 20-day run in SPY, and so I want to kind of place that into context. Or actually about a 40-day, really. Over the last 40 days, let me zoom this up a little bit so you can see a little easier. So taking a look at the 40-day holding period in SPY, today, compared to 40 days ago, the market is up 11.07%. That's a z-score of 1.23, which means that it's outside that bound of normal of plus or minus 1 standard deviation, so it's about 2% above that. That z-score 1.23 tells us that it's exceptionally good. The technology at 1.31 is also past its normal upward stretch for a 40-day holding period. Diamonds, which had been in the lead all of last year, are right at their upper boundary, holding at plus 8.52%. And when you look across at all of the indexes, they're all basically either right at the boundary or above that boundary for having had exceptional moves. When we scale that down now to the let's see, to the last 10 days, you can see that some of the steam has come out of this bull, but without failing, which is nice. If we go down now to the 5-day look-back period, you know, the standard deviation is 3.38%. Today, compared to 5 days ago, the market is actually a minus 0.07%, so basically flat to where it was 5 days ago. And what's nice about that is that was accompanied by an orderly pullback or an orderly sideways move. And because it has failed to fail in those 5 days, it's cooled off a little bit without losing a lot of money. That could be the pause that refreshes, or Friday's gap down in doji could be the indecision point. And then if it were to fail a normal amount in 5 days, the normal amount would be to lose another 3.34%. And that would get it down. That would take $4 off this. That's how we come up with that downside normal target of about 130 in the S&P. And if you look at across all of the indexes, really only the small caps stand out at having lost 1.71%. Their z-score is 0.42. So that'll show all these ones that are in red are the ones that are underwater compared to the last 5 days. So we're using that to help us estimate the downside risk. Moving on. That's everything I want to show off the daily. I want to shift our attention now to some charts that came out of the chat room and the live trading workshop this week. Some very, very important charts to show. The first one I want to look at is a conceptual chart. This was Pete Skopanich was at the live trading workshop, and he's been trading Netflix extensively the last couple of months, and so we were looking at ways to kind of improve his technique. And here's one of the things that we came up with. Now, what I've done on this chart is removed all the candlestick price action to make it very, very simple. And I actually am starting to enjoy trading this way without the candlesticks. And I want to orient you to the chart. This solid red line in the middle is the 30-period Bollinger Band median. That's the mean. It really is a 30-period moving average, and we're using 3-minute candles on this one, even though they're suppressed. So this is a 3-minute chart. The red line I'm treating as the normal current trend. You can see there's a long period of time in here where it was flat and sideways. So sideways quiet channel. The next thing around it is arrayed the blue area. That's really just that first Bollinger Band 30-period look back and creating the boundaries of normal around the trend. All right. The black line is our old friend, the 30-period regression line. So that's actually computing 90 minutes worth of data and plotting that as a continuous adaptive regression line here. The green line is the 10-period regression line 10, and it is a very close proxy for price. So what I wanted to do on this was smooth out price by hiding the candles and then just using the regression line, the 10-period regression line as a substitute for price. And then I've been watching where the crossovers occur. And so I get very interested when price makes a crossover, the green crosses the black, outside of the normal boundary. That is something that I'm treating as a potential turning point in the market. The final thing to notice on this is this solid, thick line made up of these purple blobs. That's the VWAP, or the volume-weighted average price. We started using that this week. It looks like it acts like a magnet for price the later that you go during the day. So we've been using that as another potential profit target for price to return to the VWAP, so that the market makers and the institutional money can get their books cleaned up by the end of the day. Now, this is symbol Netflix, NFLX. It was trading around 125-ish, as you'll notice. And this dotted line is where the market opened. And so what Pete's going to take a trade in here on the short side. And what he's done is we found the low of the day so far, labeled LOD, and that's this thick red horizontal line at about 124.80. And then Pete knows from yesterday that yesterday's low of the day, or the YLOD, is this price here at about 123.70. Now what we noticed was that Netflix gapped down at the open, and then price went up, and then oscillated around a couple times, got into the sideways channel, hinted at breaking out, but then failed at 125.80, which was yesterday's VWAP. That was yesterday's closing volume-weighted average price, or what we might consider fair value from yesterday. And then it rolled over sharply, and then just outside the Bollinger Band in this green circle, the green line crosses the red line, and that's a break. That's an RLCO, regression line crossover outside of the Bollinger Band, and that's the first hint that this thing might be failing and that we could have a good trend to the downside. Well, in fact, it really did. What I want you to notice, inside the blue, you see that little white area? That's when price is in the blue, it shows up as a white line, and then it gets hidden once it gets outside of normal. And you can see here just how tightly the 10-period regression line tracks price all the way through here. So we're justified in using green line as a substitute, a smoothed price, and to help us make our decisions a little easier when not being distracted by these candles jumping around. That's what I'm finding. So what Pete had actually set up was a short that he decided that when it started getting weak, it rolled over and broke through the Bollinger Band region and across the mean, and then out of the Bollinger Band region, he decided if Netflix breaks through its today's low of the day at about 124.80, that he would go short with a target toward yesterday's LOD, and he's going to use about a 20-cent stop. In this case, he was going to use the return to the Bollinger Band. And so he ends up getting short here at 124.80. It failed in about 10 minutes or 15 minutes. It went from 124.80 directly down to yesterday's low of the day at 123.70, and then price reversed and started marching back up. Now, we notice when regression lines make crosses, when the 10 crosses the 30 outside of the Bollinger Band, that's an indication that that particular trend was over and that it's starting to reverse. And when we get a reversal at an extreme in the Bollinger Band regions, out beyond 1, a reversal, the target is back to the Bollinger Band mean, which in this case is also shared by the VWAP at 125. So there are two things that are going to pull that price from this reversion, this turning point, back up to about 125-ish, and that's the Bollinger Band median and the VWAP. So really, what Pete decided to do was cover this at 123.80 because it had fallen as far as 123.60, and then failed to fail further, and then started retracing pretty sharply. He decided with a 20-cent stop, he was just going to give it back 1R, and so he gets out at 123.80. So he goes short at 124.80. 20 minutes later, covers at 123.80, and has made a full point on his shares. And so if he's risked $1,000 in the trade, he can buy 500 shares of Netflix, and he's made $500 in 20 minutes. Now, this is purely trading inside the yellow zone. What he had set up was a reason to believe that it could fail quickly to the yesterday's low of the day. Why? Because it failed through today's low of the day. Now, what I want you to notice is that with a 20-cent stop, he's got a 5-to-1 reward to risk ratio inside here, and so he's fully justified in trading inside the yellow zone, and so he's able to make a really nice profit here. Oh, let me take that back. If he's willing to risk $1,000 with a 20-cent initial stop, he can have up to 5,000 shares. And 5,000 shares on $1 is 5K. And so you can do the math on that and discover that, if you're properly capitalized for day trading, you can make serious coin. Now the next thing I want to show here is that same chart, but now I've put my usual chart markups back on here, and I want to highlight the same kinds of decision points. So now we can see how noisy it is with the candlesticks on there. The blue line in this case is the 10-period regression line. All the other things remain the same. And I want you to notice how well the blue line describes price. So it actually is a very smooth proxy for price. And now you can see the crossover occurs outside the Bollinger Band. The 10 crosses the 30 and goes south. Now there are a number of choice points in here. You can get short when the crossover occurs. You can get short when it crosses through the Bollinger Band. You can get short when it breaks out of the blue zone. You can get short when it crosses the orange into the green. You can get short when it crosses yesterday's low of the day. You can get short when it breaks through the green region. You should be thinking about covering when it hesitates near yesterday's low of the day, or when it makes a reversal at an extreme. So price got as low as 123.50 and starts retracing back up. Pete decided to cover here at about, and he got a fill at 123.80. And now, really, you have to get out of that short position not later than when the regression line crossover occurs. So your discretion occurs between this long tail and when the blue line crosses the red. I want you to notice that if you're tracking this with the MACD histogram, you can see the sideways congestion here corresponds with sideways congestion here. This little false breakout to the top is the jaws of the MACD opening up, but they close and reverse here almost around the time the regression line crossover occurs, and then the jaws of the dragon open up to the downside and then start rolling over pretty quickly when that bottoming tail gets in. And then the jaws are closed right here by noon, and so right around in this region between the when the MACD histogram line crosses over, where you've given back an R, and really it corresponds to when the regression line 10 makes its turning point. So when that thing turns up, somewhere between the turn, the stop, the turn, and the cross, you've got some discretion in here about when to exit, but you've got to exit in that region in order to make bank on this what turns out to be a very nice trending move. Now, Pete decided in his trading plan to wait for the cross at this low of the day, and he gets his fill at 124.80. That same trade can get you short a point earlier at about 125.60 if you take it when the crossover occurs. And so you have some room to decide from when the crossover occurs to the low of the day when you can get some price improvement. Now, what does that look like in terms of time and distance? That's what the next chart's going to show. This chart simply shows all the things that I said in the last point. Each little blue circle represents an area in which a decision could be made or should be made. We have this period of sideways quiet channel. We have the crossover, crossing the Bollinger Band, leaving the blue, leaving the orange, breaking to a new low of the day, a rejection of yesterday's low of the day, not later than the crossover, and now our target is back to the Bollinger Band median and or the VWAP. So there's technically even a trade possible here. And so what we did later in that day in the trade room was we looked at taking Netflix long at 124.20. Why? This is like a panda right here. You had a rebound from extreme conditions, made the crossover, so now we have a long orientation with a target at the Bollinger Band. It pulled back, and it did not fail further. It actually found support, so you can actually get long here with an initial target of return to the mean, and then at a subsequent target to the far regions of the blue. All based off of support and resistance, Bollinger Bands, and an appreciation for how far it can move on these failures. So now I want to go back to the same trade, and now pull the we're going to pull the candles off of it again, and I just want to highlight what I consider to be the discretion zones for improving entries and the discretion zone for improving exits. This is where that crossover occurred outside of the Bollinger Band, and then in Pete's plan we had to get long by making a new low of the day, and that's sort of my general rule intraday, that you should always consider getting short when it makes a new low of the day, particularly because when they fail, that next move is sharp, just like this. So between this crossover and the crossover new low of the day, it took this long in terms of time, and you had this much discretion in terms of price about when to get open. You can see how what I'm calling the jaws of this dragon are getting wider and wider and wider until they stop getting wider. So between the turning point in the 10-period regression line and the formal crossover of the 30-period regression line, you have about 10 minutes and about $1 or about 80 cents of price action in order to make to exercise some discretion about where you're going to get out. But you have to start thinking about getting short here at the crossover on the top. You have to be short by the not later than crossing over the new low of the day, otherwise you'll never take it short. And then you have to start thinking about covering when it rejects yesterday's low of the day and the 10-period regression line changes, and then you have to be covered not later than when the crossover occurs. So that gives you about another 10 minutes and about 80 cents worth of price for you to exercise your discretion. Now what I want you to notice on this one is that at this point halfway back into the blue, rather than failing and then going back to retest, the price rolled over and kept going up. By the time it made that decision to keep going up and the blue regression line hits like a little channel and then buy on dip and starts going, by the time that it has made that move, the 30-period regression line has completely rolled over and started to hook up. That's a very favorable sign for an extension of this counter trend move back to the VWAP. Now, by the time that the regression line, the 10-period regression line, gets to the far side of the blue, you'll notice that the 30-period regression line has gotten back to the Bollinger Band mean, and in the time that it takes the 30-period regression line to turn and hook that far, the Bollinger Band mean itself, the 30-period simple moving average, has started to get sideways. The slope down has stalled, and it's actually starting to go sideways. So that's how these things work in tandem. Price followed by then the 10, then the 30, then the Bollinger Band mean. Now what's interesting to note on this is that the VWAP hardly moved at all. And what that's telling you is is that downward move occurs on not very significant amounts of volume, and so when it starts to reverse, you have extra information that you should be covering, because it's not, this downward move is not being supported by a lot of volume, and so the recovery should come back to the VWAP, and now we can think about getting long inside this second yellow box with the idea of targeting the VWAP for later that day, and that is a very good trade. And so this is the final version of that trade, where in fact price, the blue line, after it made the reversal and then crossed the 30, it actually got as far as actually got through the VWAP, out of the blue, went up to 125.40, and then started pulling back. So if we had been long anywhere in this discretionary box here with an idea of making this trade, we have to have that covered by 125.13, which means that we can play from not later than 124.20 to 125.13, and guess what? There's another dollar in there in the same position size that earned $1 a share on the downside, rewards with another $1 a share, and all it ever did was trade from the VWAP all the way down and then back to the VWAP, and you have more than $1 move in each direction, and that's how you become a Netflix trader, by knowing what the difference between normal and abnormal moves are, guided by these regression lines. It's a very powerful technique. Guess what? This what I just showed you was the regression lines on 3 minutes. Now let's zoom all the way out to a 12-year chart on the S&P with monthly price. So now all these purple dots are the very volume-weighted average price of the S&P on a monthly basis, and this looks back 12 years. So this is the peak of the internet bubble, the big sell-off, 2001 to 2002, the long bull grind out of it to the peak around 2008, and then the sharp, horrible bear, followed by the two grinding bulls up, and now here's where we are just outside the Bollinger Band. Now we have a 10-month regression line in blue, and we have a 30-period regression line, 30-month regression line in black, and I want you to notice where the crossovers occur. One crossover here, a short period of time here, but another crossover here, go short. It tells you to get long here at 85 in January of 2003, and then you get short. I mean, you cover that here. You can get long again here. It tells you to get short at the peak at 155 in 2008. If you wait for it to cross the Bollinger Band or leave the Bollinger Band, you can still get short here at 125, and you can ride it all the way down till you cover that short when it crosses at 85, or you get short anywhere between, I mean, you get long, you cover that short anywhere between 70 and 85, and you get all of this to the upside. I'm telling you, the 10-30 regression line crossover works on 3-minute charts all the way out to monthly charts, and it's something that you can add to your arsenal. It's better than a moving average. Why? Because it's more adaptive than a moving average. Look how quickly it adapts to price in the blue line. So a regression line is the best fit line for a set of data. The moving average is simply a point that shows the average. It doesn't give you a sense of change of direction, but the regression line does. So anything that should work with moving average crossovers, a fast and a slow, works even better with regression lines, as you can see. So this is something for you to study. I've made it part of my arsenal. It's an important technique. Now here is how we use this on Friday to capture more than 10R in the VIX. What we had in the VIX was, this is the afternoon, we had a sideways quiet channel, and I've hidden the candle prices, and what we had was a breakout above the blue, and in this case price is the blue line, and let me see if I can't make that a little larger for you. Anyway, what you can see is the blue line leaves, so we get long at 27.25, and then price just takes off and goes to $29.25, so $2, and we were using a 20-cent stop. And then when you buy the pullback, or you cash it on the pullback, it got as high as about $29.40, and then the 10-period regression line rolls over sharply. So you know that we've got to be exiting this not later than when the blue line crosses the black. And so just this little pullback was enough to cover it and we got a fill at 29.14. That's almost 9R in a period of time from 1320 at the breakout to 1500. So in about 90 minutes, we had nothing but a runaway freight train in the VIX after a quiet day. It just exploded out of lunchtime, sideways quiet channel, and that worked very powerfully. This is what it looks like when you put the candlesticks back in there, and I paint in all of the other Bollinger Band pieces. So you can see the slope of the Bollinger Band mean here is flat, and we have a Bollinger Band pinch, very narrow range. That's sideways quiet channel by definition. Right in here, the blue line crosses the black and leaves so the 10 crosses over the 30, and it leaves the blue of the Bollinger Band, so it's out of the normal and moving higher, so we can buy it, and then it never looks back, and then we get this extraordinary move all the way up in a parabolic top, and then we end up cashing it here at 29.15 on that big red candle as it's forming. We weren't surprised. We knew that it was irrational exuberance, and so the counter trend trade, the guys in the room did it. All praise to Rodrigo. When the regression line crossed over at 28.93, our target is 28.14, and then you can set a secondary target at the VWAP. Guess what? In the next 15 or 20 minutes, the price moves from 29.15 all the way back down to the VWAP, and there's a way to capture that overreaction move now to the downside. All because we can tell the difference between normal and abnormal moves. So that's an example of how we can use the regression lines and the Bollinger Bands intraday in conjunction with the fraud quality number and the fail stat and all that jazz. But this is how we were trading throughout the week in the afternoon. So breakout from sideways quiet channel can be very lucrative. And what that general approach can get you, let me see if I can pull this up now. The last chart I'll show you. This is a scatter plot of my trading based on the techniques that I've been describing here with the regression line crossovers and the fraud quality number and the Bollinger Band treatment. And nothing worse than a 1R loss. Lots of wins in between 0.5 and 2. And then these were the two VIX. I had a 3R and then an 8R in that VIX. I took that in 2 stages. And so that gave the last 2 trades of the week for me, gave me an additional 11R. And this style of trading gave some results like these. I had a total of 100. I took 109 trades. Whoops. Wonder why that's showing so crazy. Hold on. Well, it's giving a really weird view. Let me not cover that. I want to shift back to Monsanto, looking at the week ahead. Okay, so Monsanto was a max pain range compression. It ended in a doji, had a great auto framer reward to risk ratio. It was this is a fantastic setup for us. Price is above the 50, which is above the 200. It's had a nice move up, hit a peak at about 84. It has pulled back to 77. That's almost a 10% pullback that ends in a doji. It's at a support level where this breakout and big range candle ended up at about 77. It's right back to 77, and so we can buy it at 5 cents above Friday's doji at right around 78. It could get to 81 very easily, or even 80. If it breaks through there, it could get to 84 easily, and our risk is going to be very low. So Monsanto is channeling. It had been exceptionally strong on an annual Williams %R. This looks like an orderly pullback on something that broke out from a strong support area. So that is the perfect expression of this approach to swing trading that I have been espousing. So Monsanto will be of interest. So anyway, we're about an hour and 7 minutes into this thing. So I'm going to go ahead and shut it off here. Yeah, Mike asked me 109 for the whole. Yeah, I took 109 trades. I was averaging about 20 trades a day over 7 hours. That's 2 or 3 per hour. And firing my bullets, taking my profits, banking the profits, and recharging my ammunition, if you will. And let me see if I can get back to the spreadsheet. No, it's still giving me a. Yeah. Anyway, 109 trades. The win rate was 60%. There were 15% scratches, in other words, 0 R's, and 21% losers. And the average wins were twice the size of the average loss. So you can do the math on that. I was pretty happy with what we had there. Okay, so you can look inside the chat room. I've uploaded the trading log for that week, and to get an idea for what a systematic approach to structured day trading and swing trading can look like. So I'll go ahead and shut her down here. I'll stick around for a couple questions, but I got some things to do a little bit later tonight. So I'll get this video processed and hung for you on YouTube. Otherwise, I'll see you in the chat room, and hopefully whetted your appetite for green zone, yellow zone trading, and swing and day trading, and the regression line crossover technique. I'm telling you, on any time frame, you have to put those on there with those 30-period Bollinger Bands and get an idea of what normal looks like for you on your instruments and in your favored time frames. So many thanks to the guys who gutted it out with me all week. Rodrigo and Adolfo especially are in here tonight. I'm glad to see you got home safe, and God bless you all, and we'll see you on the objective.